days. We're opening at about 25,278, about a 0.25% lower. The Nifty Bank is starting about 1/3% lower, 59,400. The Sensex is down about 1/4, and the mid-cap index is absolutely flat as well. What do we have? I mean, 60 lower on the Nifty, so 25,275 now. Nifty heat map on the 50 stocks. So what do we have? L&T on one end after numbers, Hindalco, Tata Steel, Power Grid, and on the other end you got Maruti, Indigo, Dr. Reddy. So more down than up, and it's about a 0.25% lower start. So we'll give it some time and see if the broad upward thrust from very, very deeply oversold levels as we came into this week continues, and we see that once again. So 25,266. Let's talk about individual names, Rima.
Well, it's L&T right on top with a gain of 3% now, 3,900 on L&T. Very strong ordering activity seen in Q3. And the company has said that they will be unveiling a 5-year plan in May of 2026, which is post the Q4 numbers. The street is excited. So that is clearly the stock of the day on the way up. Hindalco, ONGC, Power Grid are also up. Those gains are about 0.5%. On the way down, it's Maruti Suzuki. Operational numbers, according to the analysts, look fine, but the stock is sulking. It was lower by 2.5% yesterday, another 3% gone on Maruti Suzuki. One thing that stood out is the management said in the conference call that there was a 60 basis points impact on the company's EBIT margins on the back of commodity inflation. And the way commodity prices are rising, maybe that is a real risk. So Maruti Suzuki down nearly 2.5%. Asian Paints is also hurting. It's lost 8.5% this week. 1.5% down for the day. We've seen a rise in crude prices plus the rupee depreciation. Not good news for Asian Paints. Even Interglobe Aviation is down over 1%. M&M is weakish. M&M has lost nearly 1%. Kotak Mahindra Bank under pressure. Dr. Reddy's is weak in trade. And IT is a little sideways, more on the downside. TCS, HCL Tech under pressure. But the standout movers are L&T on the way up, 3% up. On the way down, it's Maruti Suzuki and some stocks like Interglobe Aviation, Asian Paints, which get impacted due to the rise in crude prices.
All right, Rima, a few stocks, so some stars from the broader markets that have done well. Somani Ceramics, that stock is up close to around 8%. So big move is what we're seeing out there. I think that's an earnings reaction that we're seeing. Blockbuster move out there. You also have Gland Pharma. Stock is up 8%. Remember, I recall a couple of quarters ago, they reported disappointing numbers. But for this time being, the street likes their numbers. Explains why that one as well is up close to around 8%. Another one, Manorama. We don't talk about the stock very often. Volumes though fairly high for the first minute of trade. Numbers came out there. Numbers look good. Stock had pulled back earlier. Stock is up close to around 6%. So good move is what we're seeing on that particular name as well. What else? Metals continue to shine. Well, you have copper, Hindustan Copper that is. That's up close to around 8%. It was hard to justify the stock at 500, 550 rupees. But that's the thing with metals. Valuations come secondary. Momentum is what counts and explains why this stock is having an absolute blockbuster move. Nalco as well is up close to around 2%. So good move out there. Vedanta is holding higher in today's trading session. Hindustan Zinc, it started off with a cut of around 2%, but that dip got bought into mild scaling down of the OFS that Vedanta wanted to do. Earlier, they were looking to sell close to around 6.7 crore shares. Now they're going to be selling close to around 2 crore shares less. So that's why that stock, in fact, is, Hindustan Zinc is under some pressure, though that dip has got bought into. Gold financiers, they are twinkling. The other way of playing this entire, gold surge that you're seeing, cost of borrowing subdued, gold prices moving up. Muthoot is up in today's trading session. Pull up Manappuram, that's not up so much. You want to stick to the leader, though it's coming expensive, it appears. So that's why you have Muthoot, that's up close to 2.5%. Prashant.
Lots moving in terms of single stocks, and we will get down to it and highlight some of the outlier moves as we go along. But I mean, I think the bulk of what's starting strong and not strong, we've highlighted. About a 0.25% lower on the Nifty is where we are at, 25,278. Ashish Gupta is now with us. He's a market master of the day, He's Chief Investment Officer at Axis AMC. Ashish, good morning. Good to have you with us here. Thanks very much. So I have to ask you, markets we'll get to, but the budgets, this session, we've got about 2 sessions out, right? I mean, just thematically, if you were to think about it, 2 questions actually. Will it be a good budget? When I say good, good for the market, obviously. And second, in what way will it be good?
So, hi, Prashant. Prashant, I think the good news is that we are going into the budget this time around with fairly muted expectations. So, I think that's a positive going into the budget. Frankly, we have already seen a lot of positive steps taken by the government outside the budget in the last 6-9 months. Right, so we have had indirect tax cuts, we had labor code, we had additional announcements on production incentives recently in the trade deal. So it is not really so much that can be done in the budget at this point of time. I think the more important indicator will be on the path to fiscal consolidation and policy stability. We have seen really a sell-off in the bond market over the last 6 months, despite very aggressive monetary action. And I think some comfort is needed by the markets on that front. So I think if the paths of fiscal consolidation can be reiterated, there is more confidence that comes to the market in terms of the supply of bonds that will come to the market. That will be a big positive. There are expectations built around if they are going to be tinkering around the capital gains tax, etc. Frankly, we don't have too much expectations there. And as I mentioned, stability in taxation policy is equally important. I think one area where there can be potentially some positive coming through is if we do something on the withholding tax. Capital outflows have been a big pain point over the last 12 months. And I think if withholding tax regime can be revisited, that should actually help at least debt capital flows into the market. So I think that would be one area I would look at.
Just one thing, Ashish, you said, stocks typically like more deficit spending. You're saying that it'll be nice if fiscal deficit is contracted, right? I mean, expectation is it'll be 4.4 and then 4.3, 4.2, this, the budgeted number. So you're saying that's what markets, stock markets would like? Bond markets, of course, is another story, but what's your sense?
Well, I think the equity markets will also like that. I think what we need is really lower cost of capital. Given the kind of pressure the currency has been and the forex intervention that has been undertaken, if you see today, interest rates are actually higher than where they were in September, right? So the 10-year bond yield is up about 20-25 basis points compared to September, since when RBI has cut rate by about 75 basis points. In the last 2 months or so, even the short-term rates have hardened by about 40-50 basis points. So I think we need really more comfort to come in the bond market and money market for the equity markets, because the equity market respond to growth, right? And you need better financial conditions, stronger credit growth to be supported. And if we have a challenge on credit demand being met, that will clearly not be positive for the equity markets.
Ashish, hi, morning. The expectation was that earnings recovery will take place. FY27 is going to be much better in terms of earnings growth, maybe a mid-teens kind of a growth. After last year's underperformance, which was the worst seen in 2 decades, even the valuation premium of India has narrowed considerably. Yet Indian markets continue to struggle and underperform global markets. So what explains that, and what is your view on equities now?
So I think clearly on both these fronts, you are right that earnings growth is looking much better. Even if we look at the earnings that have come through for this quarter, they have been reasonably good, not just in the large cap, even mid and small cap earnings have come in fairly decent. We are looking at 20% plus growth for most of the mid and small caps that have reported so far. I think the challenge has been, or where the expectations have proven to be wrong, is how strong the global growth is. And last year, actually, global growth has held up very, very well. Global growth is likely to be nearly 3.5% for 2025. And the earnings recovery in other markets has been much stronger. In fact, if I look at 2026 earnings for the broader emerging markets, that is now expected to be nearly 22%. Even in the US, so if you recall, in the US till last year, really earnings growth was only a Mag 7 story. But now that earnings recovery has become much more broad based. So even companies outside the Mag 7, you are actually looking at mid-teen earnings growth in the US. And US GDP till now has belied all expectations, despite all the tariffs, immigration policy, etc. If you recall, last quarter, US real GDP growth was about 4%. In fact, US nominal GDP growth last quarter at 8% was very similar to India's nominal GDP growth. And in fact, this quarter, US real GDP growth is likely to be even higher than the last quarter. So in this scenario, actually, we have not seen capital flows coming to India. So while India's growth has recovered and earnings is looking better, the recovery and earnings growth in the global market has actually been even stronger.
Okay. Hi, Ashish. Good morning. Nigel on this side, and good to see you in as always. Well, 2025 was the year of the global AI trade, and India missed out there. Now, the hope was that slows down. It's not really showing signs as of now. How important do you think that this AI trade is, and it's slowing down globally? That maybe in turn could attract some capital back into India. Your take?
Yeah. So I think that's certainly true. I think, but as I mentioned till now, what we are seeing in the US for now, the growth is actually broad basing. And it's not only just the AI. So if you look at the US small cap index, both in terms of earnings as well as price momentum, that's actually now starting to do well. And over the last 3 months, it's actually outperforming the Mag 7. In fact, 5 of the Mag 7 stocks actually underperformed the broader US market last year. So I think we are not yet seeing a slowdown. You would have seen the Fed commentary as well yesterday, that the concerns on the job market in the US have also moderated. So US growth continues to be driven not just by AI spending, but really retail spending is very robust. US manufacturing and capex is also strong. And that's why we have not really seen kind of capital flows towards India reversing, and that continues to weigh on the market.
Ashish, in terms of sectors that you like, I believe the consumption theme is something that you like. Drill it down a little bit. You like autos as well. What would qualify as the consumption basket that you like?
Yes. So we do like autos, and in autos, clearly post the GST cut, we have seen continued momentum now, even in the two-wheeler and the entry-level car segment. We are actually seeing demand and the cycle broad basing now. Even the commercial vehicle cycle is looking up. So even the CV cycle uptrend is visible. Over the last couple of months, cement demand has picked up. Actually, if you look at the macro indicators in India, as expected, over the last couple of months, they have shown steady improvement. And you look at electricity demand, you look at cement consumption, you look at e-way bills. So growth in all those pockets have picked up. And therefore, I don't think there is a concern that we are going to see disappointment in earnings growth in India. I think the challenge for the market is really that capital flows have not turned. And we saw almost $19 billion of FII outflow last year, and almost $3 billion this month. So I think that is the big challenge. I think while all the talk is around the tariffs, but the current account is still not in a very bad shape. So the current account deficit is still likely to be around 1.5% of GDP only. But it's really the turn in capital account that we need for really the currency and the markets to recover.
Okay, you briefly mentioned cement, so I'm just going to take that point a little forward because, I've been listening into some con calls and I'm looking at the results as well. Quarter 3 was on expected lines weak. But if you're looking at a domestic play and where there is traction on ground, and as you said, December was strong and January has been fairly good. Will cement be something that you'll be looking at? Domestic play on the economy as well? And we're seeing traction both on pricing as well as on volumes.
Yes, so I think certainly, and it's a sector that has not really performed last year. We are also seeing one very strong structural theme of consolidation in that sector. So I think cement is clearly ticking the boxes on multiple counts.
All right. We leave the conversation here. Ashish, thank you very much for joining in and explaining so beautifully what is really the problem when it comes to India and why India is not recovering or seeing a pickup despite that expected earnings growth. But let's move on now to a corporate conversation. Lodha Developers reported a decent set of Q3 numbers. Pre-sales rose 25%, driven by healthy demand, robust bookings during the quarter, but collections have remained weak. Sushil Modi, Director of Finance, Lodha Group, is now joining in. Thank you very much for joining in. Before we get to the internals of the quarter, just going by what the price action in the real estate index or individual stocks is telling us. The realty index is down 30% from its peak. Your stock is closer to the 52-week lows. Is that telling us that maybe demand may not be weak right now, but it is slowing out? You've hit a bit of an air pocket. How is demand?
Hi, Rima. Morning. You have related to something which perhaps is difficult for us to understand as well. And we would also be looking for the answer. And as much that we start looking for that answer, seeing the fundamental business and the underlying industry trend, I don't see anything different vis-a-vis what we have spoken before. The structural strength of housing in our country continues to remain robust, and which is what you are seeing in the performance outcome of the tier 1 developers in the country. And ours is no different. You just mentioned that we delivered 25% top line growth, delivering 5,600 crore of sales in this quarter. That's one. But really speaking, you used to see it from the standpoint of multiple milestones that we have achieved in this quarter. The number one, we crossed 5,000 crore number pre-sales for the first time in our own journey. And registering 25% growth. Number two, we did the business development of as high as 33,000 crore this quarter, and in 9 months so far 58,000 crore, which is 2.5 times of our own guidance of 25,000 crore. So another milestone for the company, best ever. I don't know whether maybe best ever in the industry in a particular year. And this quarter also saw Lodha getting into a newer geography whereby we have tied up land parcels as part of our business development in the NCR. So all of these combined alongside the fact we still saw another 1% price increase during the quarter and sold around 17% or 23% increase in the area square footages that we have sold. I think all that connected clearly says that our belief and our confidence in the underlying strength is absolutely dot on, and we don't see any different going forward.
Okay, all right. Hi, Sushil. Good morning and good to see you. When you briefly mentioned NCR, and you're entering the NCR market in FY27, where in fact another listed peer, which is Signature Global, they have spoken about a little bit of a slowdown. What makes you bullish on the market? What's the plan out there?
So, Nigel, morning. In any case, the business strategies are never made basis a quarter or a year performance, right? NCR today is the second largest housing demand, carrying in the country. It's like now 130,000 crore size of the market, which is just next to MMR, Mumbai. So thereby, a top-notch brand like Lodha, not getting into NCR, at some point we have to get in. And our strategy of venturing into any new cities, in any case, is always far more, thought through rather than going aggressive. As we have demonstrated, when it comes to Bangalore, we entered in 2022, but for 2 years we did not do much beyond 2 land parcels that we had tied up. So here also, it will be far more measured in the NCR. We have just tied up 2 land parcel, which we will launch sometime in next financial year, and go alongside how things are evolving in NCR. But nonetheless, the fact that our industry is seeing significant amount of consolidation amongst the top tier names, kind of keeps us bullish that irrespective on the ground, even if for some reason NCR has any issues, which we don't see as much as being thought as being heard, we will continue to deliver better even in that market.
Nigel put it mildly, and I'm just Sushil. Hi, morning. I heard from one of the consultants who was in our office a couple of days back. I asked him about NCR. He said he used a much stronger word. He almost, I think, called it a crisis, saying it's a pretty dire, I think dire situation is what he called it. So, Sushil, but you're saying it's not even slowed down. I mean, it's all fine. That's what your feedback is. NCR. I understand it's not one quarter, it's not a few months, and it's the largest market and all of that. But we live incrementally. So the change incrementally is slower or faster?
So to that extent, you are right, Prashant. Morning. The NCR market, on a relative terms as compared to last year, perhaps is somewhat kind of cooling down, and which is very much warranted, because the heating up to that extent where somebody says that you keep hearing that everything got sold in a week's time or in a month's time does not really reflect great. So to that extent, we are no more hearing that kind of phenomena. But nonetheless, the sales, which generally as Lodha, as a developer who believes in the sustenance sales rather than a sales basis just doing launches and launches, it kind of gels pretty well for us. Neither do we look forward to that kind of sales, because we want to sell throughout the life cycle of the gestation period of the construction, which is in any case is more like 3.5, 4 years. To that extent, the market is somewhat cooling vis-a-vis the heat that it has ended up in getting in last 3-4 years.
Is that getting reflected in the pricing in the NCR market anecdotally? If compared to last year, what would be a like-to-like price? How much lower would it be?
I think even as much that, we pick up the prices continues to see some bit of an upward movement. But yes, it is no more seeing what it saw last 3 years, where 15% price increase was happening every year, which obviously can challenge the affordability. And that's the last thing that in a way our industry needs, because, and that's our theme. We said from day one for last 4 years since listing that the price increase should always be far more measured to kind of only strengthen the affordability, and which is where we feel the price growth should always be more like 5-6% every year. And to that extent, 15% that happened was completely undesirable for the industry. And that mellowing down, more getting in sync with what it deserves, I think is healthy, and perhaps only will strengthen the industry going forward.
So prices are going up, but in a more measured 4-5% kind of a way, and not the 15% annual increment in prices that we were seeing over the last 3 years. And this is applicable even for the ultra-luxury properties in Mumbai, because Lodha in Mumbai is known for its very premium properties, where again the price rise has been quite meteoric. What is happening on that front?
So you and me, we both are sitting in Mumbai. So to that extent, yes, as you know, our brand strength is catering to the entire demography, starting from the mid-income to premium to super premium and ultra luxury as well. So in our business, we don't see any difference between the various segments, be it ultra luxury or premium or mid-income. The price increase philosophy that we have taken is for all the segment, because that's what strengthens the industry and kind of ensure that the demand continues to remain robust going forward as well.
Okay, all right. Sushil, tell us a little about the data center business. That MOU that was signed with the Maharashtra government. What is the total investment from Lodha? What is the completion timeline? And possibly expected revenues as well?
So Nigel, a data center is to be seen more in the context of unlocking of significant value for Lodha and for its stakeholders knowing that at Palava, we had a significant land holdings, around 4,300 odd acres. So this has come out as one more avenue to unfold, and unfold and unlock significant value, whereby the land prices, which so far was more in the range of 10 crore per acre for the various other uses, except housing. Obviously, housing after value add, the price point for the underlying land will more work out to 40-50 crore per acre. So the data center as an opportunity has enabled one more avenue for us to unlock the similar or even better value. Under this MOU that we have done, with the committing a lakh 30,000 crore of overall investment, and this investment, just keep a note, it is the entire investment, be it Lodha or be it anybody else whom Lodha brings to operate the data center, combined has to be delivered, and which gets delivered with a 350 gigawatt of capacity of a data center once constructed. As against what we have already on plate.
I think we lost that line, but I think we perhaps got the gist of what Lodha was telling us. I'll just give it a 10-second. Okay, I think he's back. Please continue. Please finish that point.
Okay, don't know where I get lost, but let me just reiterate. The data center as an unlocking a significant value for Lodha has the ability to deliver the land price points perhaps even better than what we otherwise fetch under the residential business, which is with the MOU of investment MOU that we have signed of a lakh 30,000 crore, which can get delivered just by 350 gigawatt of data center capacity getting operational, and that's against 3 gigawatt of overall capacity as of now on 400 acre of land that can be constructed at Palava. So 10% of the capacity once gets operational, the whole commitment of the investment gets met. But what it brings on the table is this MOU enables lot many fiscal incentive for our data center operator, which makes it one of its kind location for for running the data center, which in any case, as you know, in the age of artificial intelligence, is becoming such a critical ingredient infrastructure. So we thereby see that we continue land sale to the data center operator, who then invest in this facility, will unlock value, because we will potentially have the ability to realize the land sale price now maybe 50, 60, 70 crore per acre going forward. That's one. And on the other side, parallelly, we will perhaps start constructing, BTS model of smaller capacity, which lot many data center operator wants the speed, wants to kind of, quickly start operation and look forward with the power cell already being ready. So which will be another piece that we will be enabling for these users.
Yeah, thank you very much. We wish you the best of luck, and I hope you come back mid-quarter as well, as we assess progress on some of these plans and maybe an update on the NCR market as well. Thank you very much for joining us. Appreciate it. There's a news flash at the bottom of the screen. HPCL essentially has put out a clarification saying that the reports with regards to them trying to source Venezuelan crude is not correct, and the stock price move is speculative. Yeah, that's the one that I was referring to. Stocks up about 0.6%. We'll take a break. We are back with a very interesting discussion, and I think it's so relevant. If the market is convinced about anything in this budget in terms of expectations, it is the fact that the government is going to increase its spending on defense capital expenditure substantially. We have no less than the former defense secretary, Giridhar Armane, joining us to talk about this very issue in some detail. So that conversation comes up in just a bit. Well, let's focus on the defense sector ahead of the budget, which is on Sunday. Now, India recorded its highest ever defense production of 1.5 lakh crores in FY25. Morgan Stanley believes that a 12 to 15% growth is possible, but we are looking at the budgeted growth for defense capital expenditure spending for FY27 in this budget. So the budgeted growth was about 13% in FY26, and in FY27 can that number, as many are saying, be between 20 to 25%. We have Giridhar Armane, he's former Defence Secretary, now joining us. Mr. Armane, great to have you with us here, sir. Thanks very much for joining us. Mr. Armane, of course, is also our budget editor, so you'll hear from him, now on the day of the budget. He'll be with us to sort of, tell us what the announcements mean, and of course we'll analyze details after that. So let's just begin with that basic headline number, sir. What do you think? Is it possible that we see between 20 to 25% jump in the budgeted number for FY27?
Yes. Good morning. Actually, 20 to 25% looks very feasible in view of several developments in the geopolitics during last 2-3 years. As a percentage of budget, it's hovering around 13 to 13.5% over a period of time. 1% increase in the total budget outlay is going to contribute more than 1 lakh of crores. So we have to see in 2-3 perspectives entire effort. Firstly, defense capital expenditure itself is likely to grow, because many systems which were ordered previously, last 2-3 years, are going to mature in the current financial year. Further, the Government of India has approved emergency procurement for the services to replenish their inventories and stores. So that is also likely to contribute immense amounts to the entire expenditure by the MOD. Apart from that, there is complementary and supplementary expenditure from other ministries. For example, the infrastructure facilities being set up by the space, and also the science and technology departments are going to help the defense capabilities to improve further. I'm also very much excited by the investments in the semiconductors.
Right. Mr. Armane, if I can just come there. So you're saying 20 to 25% is very much possible given the geopolitical context, right? That's the headline number. And when we look at this 20 to 25, you're talking about the capital expenditure number in defense.
Yeah, capital expenditure has to grow. Yeah. And also the revenue expenditure, especially non-salary revenue expenditure, is likely to grow, because the inventories which were partially exhausted during Operation Sindoor and later have to be fully replenished. So that is likely to ensure that the non-salary revenue expenditure is likely to go up.
Yeah. So this is the 1,90,000 crore budgeted number, right? That we're talking about for FY26. So 20 to 25% on top of this 1,90,000.
That is the capex. In fact, 20 to 25% is quite possible.
Yeah.
And I'm also talking about the equipment, stores, etc., which also help the industry, defense industry, to shore up their production facilities. That is also likely to grow by 15 to 20,000 crores, approximately 15 to 20% again.
Yeah. So, when for viewers who are watching, and for investors and for companies, right, how much of what is budgeted? Because, ordering has been very strong from the government, over the last 12 months also, and before that as well. So, actually, over the last 4-5 years, ordering has been very strong. When we look at this number, 20 to 25% increase, incremental increase, how much of that is to pay for orders already given? I mean, because those tenders, etc., will be finalized and given out. And how much of that usually is for new orders which will be given in that sense? I was told it's some 80-20. 80 is for already what has been given out as orders, and 20 is new. Is that correct?
That varies, especially in a year like this, The payments for the orders, current orders also is likely to go up, especially with the emergency procurement kicking on. I expect that at least 25 to 30,000 crores additional expenditure on the current orders from the three services. This is an extraordinary year, and I think there will be a lot of expenditure on the fresh orders to the industry.
Is there a ballpark, a thumb of rule number, I mean, in that sense? Ballpark. I mean, these are very large numbers we're talking about in terms of how much of this is to pay for what has already been put out as orders and how much is new?
Yeah, see, the orders, current orders, which will be finalized and contracts entered into, will also mean some advances, some payments to the companies to start the production and to mobilize the entire production line. So that will be definitely be substantially more than the previous years.
Okay. Sir, how does India's defense spending as a percentage of GDP compare with other countries in terms of their spending? Since, right now you said the thrust for increased spending is the geopolitical situation. So what is the headroom to increase that over a medium term? And I remember, or I believe that during the Kargil war or post-Kargil war is when it had hit its peak. So could you provide some historical reference?
See, the expenditure, defense expenditure as a part of the GDP is around 1.5 to 1.9 over a period of time. But percentage of GDP is not the right measure for a country like us, a middle income country which was importing a lot of equipment from outside. So whatever we spend on importing is going out of the country and not contributing to our long-term capabilities. So percentage of GDP I will discount as a measure. However, looking at GDP as the total income of the country and how much we are spending on defense, we can be sure that it's more than 2% because, as I said earlier, complementary expenditure happening from certain civil and commercial sectors is quite high. In terms of the capabilities in this space, in terms of the research and development, we are spending through various other agencies the required amount to shore up the capabilities of our services. I would rather look at the total expenditure as a percentage of the total budget outlay, which is already 13% and above, which is the largest outlay for all the ministries and departments in the government of India. So that way, priority to defense sector has been always there, not only during Kargil or Sindoor, but this government especially has increased the capital outlay substantially over last 10 to 12 years.
Right. Mr. Armane, if I can drill down and request you to tell us, right? So which specific areas will the thrust be in your assessment? And these things are, I mean, they don't change dramatically, right? I mean, the trend of the focus and the trend in terms of the focus of spending, say towards the Air Force, towards, naval capabilities, things like drones, etc. I mean, those are longer run trends and more money. I mean, so there may be slight variation. So where should we expect a bulk of this increase in spending to be focused towards?
Capacity building plan is already in place. Capabilities also have been mapped out and the work is already on for several years. So the long-term capital expenditure will stay course like the previous years. Every year around 2 lakh crores of fresh approvals are being given. So that will continue. Apart from that, because of the recent conflicts in West Asia and Europe and in our neighborhood, we have to shore up the new age defenses and new age offensive weapons. The most important capabilities we are talking about are the AI-enhanced surveillance, including satellite imaging and analysis, predictive modeling, including machine learning, etc. Then loyal wingman, both on the surface, subsurface, that is submarine and aerial. These are going to be major technologies which will require capability building. Swarm drones is another area where we can expect a lot of work being done by the services along with the startups and the established players. I'm expecting that the quantum computing also will be firmly embedded in many of the systems in the defense sector. I foresee an age where quantum key distribution will happen in almost every communication for the government of India.
It's very useful, sir, to get a broad overall perspective, right? And I think it helps us focus on, you will be with us when the budget, of course, is being announced to point us in the right direction. But this is a very useful chat, Mr. Armani, and we're so glad that you're with us. Thank you very much for your time here on CNBC-TV18. And, Mr. Armani, of course, will be, as I said, our budget editor, and he'll be with us on the day of the budget on Sunday as well. Defense is the one area where perhaps spending is going to be strong. As he said, 20 to 25%, very possible. Defense, the index itself, 8% in 2 days, so cooling off a little bit. Valuations are another story, not cheap. Rima.
Well, IT is also cooling off. It's the worst performing sectoral index today. The Nifty IT index down 1.6%. I'm not too sure if it's to do with Microsoft, because Microsoft disappointed when it came out with their numbers, and particularly what the street was spooked by was the slowing cloud revenue growth, and even the margins were lower than expectations. So maybe there is some sentiment impact coming through on the back of that. But let's invite Birlasoft. That's the next management on the show. The company reported a weakish top-line revenue growth, just about 0.3%, but margins have been strong for the second consecutive quarter, coming in at 18.2%. Angan Guha, CEO and MD of the company, is now joining in. Thank you very much, sir, for joining in. What should we expect in Q4? Will there be some furloughs which spill over from Q3 into Q4? And how does it set you up for FY27, considering that so far in the 9 months, you've had a mid-single-digit kind of a revenue decline?
So thank you for having me. So look, Q4, as you know, has got lesser working days than Q3. I don't see any furloughs going forward in Q4. We'll have to look at how our signings, that is our focus area for Q4 as well, pan out and execute for the quarter. But overall, we are feeling reasonably confident that the worst is behind us.
So Q4 should see growth over Q3, and what kind? 1 to 2, 2 to 3, or flattish?
Yeah, so look, we don't give guidance, as you know, Rima. So we will be focusing on execution as far as Q4 is concerned. A little too hard to say because we still see the demand environment being a little sluggish. So we'll see how it goes, but our focus will be to drive execution for the quarter.
All right. Hi, Mr. Goa. Good to see you, Wayne. Let's talk about the positive then. The margins were up around 220 basis points on a sequential basis, coming at around 18.2%. Now, this is the second consecutive quarter of strong margin performance. Could you tell us what drove that and what's the guidance from here on?
So, Nigel, look, I mean, as you've stated, we have done an incredible job on execution, which has really helped the margins. And as you would recollect, 2 quarters ago, our margins were about 12% EBITDA. We've moved the margins from 12% to 18%. So pretty proud of the team. The team has executed well. But you must also realize that this has got some one-offs. Of course, the currency has helped us significantly. And there are some one-off benefits that we have got, which may not continue going forward. If we can continue to execute and deliver revenue growth, then I think, we'll continue to do well on margins. Our baseline margins will be anywhere between 15 to 16%, and then we will work on improving from there.
Okay. All right. This has been a weak year, Mr. Guha. Given that we're going to end this year as well on a weakish note, how does it set you up for FY27? Will things be better in FY27 on low base of FY26? And if you could, hint with regard to growth, what could it be? High single digit, mid single digit? Do you want to guide for double digit? Tell us.
So, Nigel, look, we don't give guidance. And I accept your point. The FY26 really has not been a good year for us. As you said, in dollar terms, we'll have a decline in FY26. But one thing I can commit to you that FY27 will definitely be better than FY26. Now, how much better? A little too early to say. If we can have a good Q4, which is our focus for now, then definitely FY27 will look much better. The entire management team's job now is to focus on funnel, pipeline, deals, and then resulting into revenue growth. We fixed all the other parts of the business. Our margins are strong, cash flows are strong. So we have not lost a single client. We are delivering great signings. Now we need to really convert that to revenue, but we are feeling good about it.
Would you look at an acquisition in FY27, considering the strong cash on the company's books?
So look, Rima, we always, look at assets from time to time, but an acquisition can only happen if we get an asset which culturally matches us and what we want to do. Like I've always stated, we will never buy a company for revenue aggregation. We will only buy a company as long as it is a strategic fit for us. For us right now, we do not want to kind of digress from the fact that we need to deliver growth. If we can deliver good, strong quarter-on-quarter revenue growth organically, then we will look at something inorganically. But first, the entire management team needs to focus and deliver quarter-on-quarter revenue growth. That's our endeavor.
Mr. Guha, morning. There is one company, mid-cap, in terms of market size on the block. You're not looking? You're not interested? I mean, you won't, or have you looked?
So, Prashant, like I said, we keep looking at a lot of deals, right? But like I said, we will only do an acquisition once we are comfortable that we can sustainably deliver, revenue growth organically. Only then we will look.
When do you think you will be in a position to start delivering sustainable quarter-on-quarter revenue growth? Will that happen sometime in FY27, Q2, Q3 of FY27, or it'll take longer?
No, I think FY27 will be a growth year for us, Rima. And our quarter-on-quarter, I would suspect that starting, Q2 of next financial year, we should be looking at sustainable revenue growth from my standpoint. And it'll all depend upon how we execute from a signings perspective in Q4 and Q1. But like I said, I mean, I think the worst is behind us, and we are positively entering FY27.
Okay, all right. Final question. The deal TCV was robust at around, $202 million. And I think the indications are that quarter 4 will be better than quarter 3. Spell it out for us.
So, you're right again, Nigel. Q3, we had a very solid year in terms of solid quarter in terms of signings. I inherently feel Q4 will be better, but there will be some renewals that will come in. And I feel that we'll have a little bit of pricing pressure. But look, we are pretty confident to commit that Q4, at least from a signings perspective, will be better than Q3.
Got that. And in terms of a sectoral mix, this quarter it was manufacturing which drove growth for you. What were the issues other than furloughs which impacted the performance in the other verticals? And in FY27 or Q4, what should we expect in terms of a broad-based growth?
Yeah, so Rima, look, again, manufacturing for us, has been a laggard. If you really look at our last 3 or 4 quarter results, there were certain deals that we had won about 2 quarters ago that showed some ramp up in Q3. I still feel manufacturing will have a soft quarter in Q4. We will need another couple of quarters to turn manufacturing around, but we are making a lot of investments in this area. We are confident that starting Q1, Q2, manufacturing will turn around. As far as financial services and healthcare is concerned, financial services obviously had furloughs this quarter. That will deliver steady performance. E&U will deliver steady performance. Life sciences for us is, again, really a manufacturing business because we work with medtech companies. That will, again, take a couple of quarters to turn around. But, starting Q1, Q2, I'm pretty confident that all of our sectors will start showing growth.
We certainly hope so. Thank you very much for joining us. It's a pleasure having you with us. Wish you all the best of luck as you execute, as you said. I mean, I think it's about bringing in, deals are coming. It's about executing, converting some of that into revenue now. So wishing you the best of luck. Take a quick commercial break here. Somil Mehta of Mirae Asset Sharekhan is going to be with us with a fundamental check on markets. So we are on the index down 150 odd points. So 2 days we accumulated about 300. And for now, we're giving back about half of it. Stay tuned. Coming up in just a bit.
Welcome back. Markets down, pulling back close to around 150 points, but we've put on a lot of weight in the last 2 days in particular. Is this the buying opportunity? Well, let's toss that question to Somil Mehta of Mirae Asset Sharekhan. Hi, Somil. Good morning. What's your take? Is this market does it still have some unfinished business at higher levels? Would you look to buy into this dip?
Good morning. Good morning. Good morning to everyone. Absolutely. I think we've had a very good correction from here. 26,300 was the top, and now 24,900, 25,000 remains a very, very crucial support. I think in the very short term, there is a very crucial support around 200 daily exponential moving average as well, which is placed at 25,160. So that remains very crucial. Now, at this point of time, Nifty is at exactly 200 daily moving average. So I think this is a very good buying opportunity. 24,900 remains a very crucial support and a stop loss as well. And on the upside, I'll be expecting this bounce to continue till the 20 daily moving average, which is placed at around 25,600, 650 levels. So yes, I'm expecting a very good bounce from here, and it's a buying opportunity.
Okay, and when does this positive view get negated, or the downside support that you're looking at?
Yes, absolutely. So overall, the structure, if you see in the medium-term outlook, is still lower tops, lower bottom formation on the weekly charts and the monthly charts, right? We are only aiming for a small bounce. Once this bounce is completed, we revisit, but overall structure still remains negative, lower top, lower bottom formation. So if it goes below 24,900, I think the next level to watch out would be 24,300, 24,200.
Got it. And individual stocks, quickly, if you could run us through that.
The buying opportunity in two stocks, real estate just reversing back, and PSU banks already doing great. Bank of Baroda is my pick. Bank of Baroda stop loss should be 298 and the target is 320. The second one, which is Lodha. Lodha is just reversing back, small inverted head and shoulder pattern on the hourly charts, momentum indicators, giving a buy signal, fresh buy signal. So stop loss would be 914 and target on the upside is 1,000.
Somil, thank you very much. Interesting times, and thank you for those trades. We'll speak again. Well, Vivek is now joining in on key MSCI developments. Vivek, take it away.
Well, some good news finally. In the last 13 months, India has seen close to 2 lakh crore of FPI selling. But there have been a couple of important MSCI announcements that's happened in the last 2 trading sessions where India may be the unintended beneficiary of some foreign buying. So the first country that is in focus in the MSCI EM index is Indonesia. MSCI has gone ahead and raised concerns on investability issues due to the shareholding structure opacity as far as Indonesia equities are concerned. So what is MSCI doing? Number one, Feb review, there will be no changes, especially in terms of inclusions as well as weight changes. The other thing is they could go ahead and decrease the weightage of Indonesian equities in the emerging market. And lastly, they will also consider going ahead and downgrading Indonesian markets to a frontier status from the emerging market status that it currently enjoys. On the back of that, Indonesia has seen significant selling pressure. The Jakarta index was down almost 7% yesterday. Today, hit the lower circuit before rebounding slightly. So this particular decision will happen in May 2026. CLSA says that the Indonesia weight in MSCI EM index is at a little over 1.1%. So dedicated funds, active, passive, APAC as well as EM funds all together hold close to $35 billion in Indonesian equities. Now, only passive funds, analysts estimate that India could receive close to $1 billion if there is a rejig and there is a downgrading of Indonesian markets. The second country that we will focus on is Greece. Now, Greece, MSCI says, could be upgraded from an emerging market to a developed market. Greece weightage in the EM index is close to 0.5%. So India could receive close to $650 million of passive inflows. Again, this will happen closer to the May review. And lastly, South Korea, this is a much longer term index review that MSCI will be deliberating on. MSCI could upgrade South Korea to a developed market from an emerging market. Remember, South Korea has a significant weightage of close to 12% in the MSCI EM index. So any change there will be staggered over 4 to 6 quarters, and India eventually could end up receiving close to $10 billion. So the bigger point is, there could be some forced FPI buying on the back of passive fund rejig if the MSCI decisions do take place.
All right, Vivek, thanks very much for that. Appreciate it. Unintended beneficiary. intended, unintended, I think dollars finding their way into the country, perhaps needed the hour. Thank you very much. We'll take a break. We're back. Latha discusses the known and unknowns as the EU-India FTA agreement. Ajay Srivastava of GTRI and Garima Kapoor of Elara Capital join her for this discussion.
Welcome to It's the Economy. India and the European Union signing up for an FTA means that EU tariffs on a bunch of Indian goods, labour-intensive goods like leather, textiles, gems, marine products, even chemicals are likely to go to zero. European cars and liquors will attract much lower tariffs in India, but all this is 1 year away. Meanwhile, which sectors must we bet on and what are the red flags? Ajay Srivastava, the founder of GTRI, that's the Global Trade Research Institute, and Garima Kapoor, Chief Economist and Head of Research at Elara Capital, join us. Garima and Mr. Srivastava, thank you very much indeed for joining us. Mr. Srivastava, the labour-intensive ones seem to be the sectors that are benefiting. Can we conclude that what we lost in US will be made up by this reduction of tariffs to zero?
So the exports to US of labor-intensive goods suffered. There is no question about this. But as you rightly said, it will take at least a year for this agreement to be implemented. So whereas US losses are current, the gains from EU will be at least 1 year away.
No, I'm asking you because when we spoke to textile exporters, for instance, they said they front-loaded, so they will somehow pull on till December. We were all hoping that the US trade deal will be signed by then. Now we have this hope 1 year from now. The point is the large-scale labor retrenchment that can happen if orders don't come in. Do you think the hope that this is anyway only a year away will ensure that at least textiles, leather and such industries will not have to retrench in a big way?
It will provide a great push to the labor-intensive exports, textiles, leather, handicrafts, marine products, everything, because we are already exporting about $8 billion worth of textile and garment, but we were getting beaten by the zero tariff access given to our competitors like Bangladesh or Vietnam. Now with that, we also get the same zero tariff access. I think our exports will get a great fillip to the EU market. It's a big market, and they import more than $200 billion of garments and textiles, and our share is less than 3%. I hope that the share increases to 7-8% in the next few years.
Okay. Garima, thank you for joining us. Would y'all want to bet on these companies right away? And if yes, which companies, for instance, in textiles and leather?
Hi, good morning, Lata. I think one thing we need to understand in the India-EU FTA, beyond the fact that it is going to get implemented over a year away, the gains are unlikely to be broad-based. Remember, EU is a difficult market when it comes to compliance. There is a ESG traceability, there's certification, and the cost of certification is also significantly high. So the gains are likely to accrue significantly disproportionately higher to those companies who already have reasonable presence in Europe. So if I were to bet myself in terms of sectors and stocks, I'll probably pick up those stocks which already have a reasonable presence in European market. Like in textiles, probably something like a Gokaldas or a KPR Mills with already presence there is probably it's stacking up much higher on my list than others who are going to now start creating certain exposure in Europe.
You know, that's a very fair point. And Mr. Srivastava, you also have written eloquently about it in your edit. How tough will it be? I'm not coming to CBAM just yet. Okay, the carbon tax is another issue, and that is more for steel, aluminium. I'm referring to the products that Garima spoke about. Do you think textiles, marine products, leather are going to be impacted because of these non-tariff barriers, so to speak, of quality certification, etc.?
I agree with Garima. See, EU is a rich market. They have medium to high-end consumers. They want only the highest quality goods. So people who are exporting from India, they all have certification. And as Garima rightly said, people who get into this certification wagon, only they will prosper. But fortunately, we have more than 1,000 companies who are certified. And I think another 1,000 are in the queue for getting certified once they are there. But the bottom line remains that EU is, they believe too much into ESG, environment, sustainability, and they can put a spanner on any country's exports any point of time. They have put in the past also. But see, we have a fair presence in the EU market. It's not a new market. Our exports, goods, services are $210 billion. So we have a fair idea of the market. Already people are exporting, and we are going to build from this base to a far bigger base.
Okay. Sir, now that I have you with us and the rupee is back to its slide again, 91.97 as we speak, of course, all-time low levels. Mr. Srivastava, what are exporters telling you? You know, we talk about this about 6% depreciation versus the dollar over year on year. But versus the Chinese renminbi, the rupee has depreciated 13% year on year. Versus the euro, again, the depreciation is, over 13%, probably 15%. Have you noticed exporters actually benefiting from this?
So old narrative that depreciation of rupee will help export will no longer work in most of the exports. Now, major exports, for example, smartphone exports, machinery exports, electronic exports, or even organic chemical exports, even pharmaceutical exports, they are import dependent. Import content varies from 60% to 90% and even more for some products. In such cases, import also become a big factor. So the old narrative, it applies to sectors where we don't have any imported inputs.
I was coming to that, sir. That's extremely well put. And we have to know that we are only value adding. That when exports become cheaper for us, then imports are becoming expensive. But I'm referring to the labor-intensive guys whom we were talking about. Leather, textiles, gems and jewelry and marine. Is there at least, a clear advantage?
So, since in these sectors, the import content is very low, almost zero in many products. So there will be a clear gains in these sectors. But if we have to, there is another point. If we have to move further, say on garment value chain. We are almost nowhere in the winter wear or the mixed fabric thing, which account for 70% of the world garment markets. We have to move on that. As far as cotton garments are there, what you say is right. Depreciation will help these exports, but the export figures are not raising. That means whatever gains were expected from depreciation of rupees, we already lost because of higher competitiveness of the competing countries.
No, that's a fair point. And in any case, our labor-intensive textiles, handicrafts, and gems and jewelry don't form an overwhelming part. The overwhelming exports are, of course, specialty chemicals, crude exports, and machinery and electronics, rising electronics, where imports are becoming more expensive. In fact, we saw the Dixon results. This time, smartphone imports are clearly going to take a hit. Okay, Garima, to come to the more difficult part. Okay, you're saying that at least in textiles, there are people who have already taken certification and they may be advantaged. What about iron and steel? Are those industries going to have a very big problem because of the CBAM, the carbon rules?
The wide expectation for some segments of the market participants was that if we were going to sign a deal of that proportion, we would probably be negotiating some kind of relaxation on the carbon border adjustment tax. Unfortunately, nothing of that sort has come. The other whammy also has been that India probably has hit a limit in terms of export quota in terms of steel to European Union as well. So we are probably looking at no further gains in exports. Now, everything else being aside, the cost implications of CBAM not getting relaxed are going to be significant for both steel and aluminium to begin with, because these are highly carbon intensive. And eventually, because CBAM will cover almost every other sector, you will see its impact also flowing to some extent into auto components, because it also has certain metallurgical components, like forging or, for that matter, casting. On immediate basis, we think there could be a price impact because of CBAM on steel and iron exports, anywhere between 20 to 30%. And that is not a great news. So I would say we will have to look at the fine prints. And while the text says that eventually if European Union does grant any relaxation on CBAM to any other country, it shall also grant the similar relaxation to India. Given the way European market functions, and it prides itself being most ESG compliant and a torchbearer of emission reduction norms, I see very limited scope that we may be able to get any significant relaxation in the near term, which of course is not very positive for our emission-intensive exports.
That's my fear as well. Mr. Srivastava, all said and done, we know this carbon border tax is going to be an issue, but that is a problem everyone is going to face, or the entire competition is going to face, and only European companies may benefit. Net, do you think our current account deficit, or rather our trade deficit, is going to be lesser after FY27 because of this deal?
There is no doubt about this. Of course, steel will be a problem, but other sectors will grow once the agreement is implemented. But as Garima said, we have to be very careful. We talk about steel, aluminum, but in next few years, every industrial product will be covered under CBAM, which means, and for agriculture product, EU has different restrictions under Deforestation Act, where agriculture products will be suffered. So in next few years, all products going to EU will have to pay some amount of tax, all products, agriculture products and industrial products. So what will happen? Their products can enter India at zero tariffs. Our products will suffer from this disability. So that will be creating some dissonance in the market for the economy.
Okay. So we have to be very, very vigilant. A quick word, Garima, current account deficit for FY28 looks lower.
The current account deficit for 28 certainly looks lower on the assumption that both UK-India FTA and EU-India FTA do get executed and start getting implemented. Broadly, I think our numbers indicate gains of anywhere between 25 to 30 basis points purely because of India-EU FTA, which to some extent negates the barrier that we had created because of very high tariff in the US market, the impact of which was found to be about 40 basis points. So broadly, a sub 1% clearly is on the horizon on the immediate next year, and maybe somewhere about 0.6, 0.75 by 28 as a percent of GDP.
Oh, that's so far away, but 91.97, 98 as we speak. You have a target, Garima?
See, on the near term, the rupee is going to be under pressure because it's not the current account that is worrying the market. It is a funding of the current account. When FPIs are continuing to sell and when you repatriate...
No, I get your point. Actually, out of time. That's why I'm pressuring you for a number. I mean, how bad does it get?
I think in the near term, you could probably hit a 92.50 and thereabouts as well, and the immediate near term.
Okay. Thanks for that, Mr. Srivastava. Thank you very much indeed for educating all of us, I guess including Garima, on the nuances of this India-EU trade. Some gains, current account and trade deficit likely to shrink, but all that is a year away. Wrap up on Bazaar, chart burst is coming up.